Hello, this is Joe Pryor, the virtual real estate team in Oklahoma, where we specialize in residential new construction for investors in the Oklahoma City and the Tulsa markets. Well, folks, we've had 3 rate cuts this year in 2025 by the Federal Reserve, and it did not result in lower mortgage rates, and that is unfortunate. We are still dealing with rates that are in the 6s for investors, and that is problematic. But I think everybody is hopeful as we go into 2026 that we are going to have lower rates. And I know I speak about this a lot specifically or in other videos, but I kind of really go into predictions right now on what we're going to see in interest rates. Now, the Fed, they were pretty hawkish on inflation in terms of the statements that they made. They knew they had to lower the rates in December because the job market does not look good. And they look at the job market and they look at inflation. And as I've said often enough here, inflation is about to kick up a little bit more. And we did see that happening, mainly because we have a situation with tariffs. And these tariffs are now being in a greater amount passed on to the public, mainly because the manufacturers, the businesses, they can only absorb so much. The importers can only absorb so much. And now it is being passed on. And that is something that is a worry on the Federal Reserve. Now, we kind of thought that we might have at least 3 more cuts in 2026, but the Fed is really talking about just 1 more cut. Now, maybe that'll change. We'll have to see what these economics do. These tariffs have gone all over the map. They're on, they're off, they're up, they're down, they're in between. It's been incredibly unpredictable. And so that is the problem in terms of making predictions. And we haven't really had good economic data come out either because of the shutdown or because the federal government is just not giving it to us. So we have kind of little information on which to base predictions. But the thing that I really think is going to happen is rates may come down a little bit. In other words, instead of a par rate at 6.5% for investors, maybe 6.25, 6.125, hopefully with points and with some contributions from the builders that you can get it down to 4.875 or 4.75. That I think is as good as we're going to see unless things change. And a lot of it has to do with tariffs. A lot of it has to do with trade. And so that is the kind of outlier which we're not sure of in terms of what we can predict. But if you're waiting for rates to come down to what builders are doing right now and these special rates at 4.99% or 5.25% fixed, I don't care what the Fed does, it's not going to go down that low in 2026. So we have some terrific rates right now that are incentives from the builders. We also have what's called DSCR loans, which is for big time investors where you have at least 10 properties and you can't do Fannie Mae anymore. We have some situations where the builders are paying as much as 6% closing cost allowance to get your rates down. So I think in 2026, you need to look for this happening. Look for the builders that can afford to give you a deal. Look for the builders that can afford to put out millions of dollars to get your rates down or pay you extra closing costs for what's called a DSCR loan. This is where investors are going to be going. This is what we're going to keep up with in 2026. A lot more is coming as we do every month what's happening with interest rates on mortgages.